What if I told you the best performing dividend ETF of the past decade just changed its entire lineup? This isn't clickbait. SCHD, an ETF I've trusted and personally invested in for years, just went through its biggest shakeup in a long time. If you care about dividend income, long-term growth, or beating the market without betting the house on high-risk stocks, this video is for you. Hey everyone, Ernie an MBA and CA, not a financial advisor, so this isn't financial advice. But I've spent years analyzing dividend ETFs, and SCHD is still the king in my book. Why? Because it checks every box. Checkmark capital appreciation, checkmark high yield, checkmark consistent dividend growth, checkmark, all wrapped in a low-cost, no-nonsense package. And once a year, SCHD quietly rebalances its entire portfolio. No hype, no headlines, but this year, the changes are big. Today, we're breaking down everything you need to know about the 2025 SCHD reconstitution. What stocks were added and dropped, how the sector exposure shifted, what this means for dividend yield and growth, and whether SCHD is still a buy today. So if you want real insights without the fluff, hit that like button. It helps the channel more than you know, and let's get into it. Before we dive into what's changed, let's cover how SCHD actually works, because it's not your typical ETF. There's no active manager. No one making calls based on emotions or market buzz. Instead, SCHD tracks the Dow Jones U.S. Dividend 100 Index, selecting companies based on at least 10 years of dividend growth, a $500 million plus market cap, minimum 2M trading volume, strong free cash flow to debt, ROE, yield, and 5-year dividend growth. Rights are excluded. No exceptions. And once a year, the top 100 qualifying stocks are slotted in, purely based on this formula. Now let's talk changes. This year, 17 stocks were dropped from the portfolio. Some big names gone include Pfizer, BlackRock US, Bancorp, Dick's Sporting Goods, H&R Block, Cracker Barrel. The biggest takeaway? Financials took a hit, big time. They went from 16% of SCHD's portfolio to just 8%. Not because anyone had a gut feeling. Just based on performance and yield metrics. Personally, I was bummed to see BlackRock and Dick's go. But again, this isn't a human making decisions. SCHD sticks to the math. 20 new names were added. Yes, 20, because SCHD had dipped below 100 stocks after a few companies were acquired last year. Top new additions: ConocoPhillips, COP, 4.6% weight, Merck, MRK, 4.1%, Schlumberger 2.3%, Target 1.9%, General Mills 1.3%. Energy made a strong return this year, and ConocoPhillips is now SCHD's top holding. That might surprise you, since no stock is supposed to go over 4%, but remember, weightings shift between rebalances, and COP's price surged during the transition. Here's where things get interesting. Compare this. Before reconstitution, 2024, healthcare 18.3%, financial 17%, consumer staples 15%, industrials 13%, energy 12%. After reconstitution, 2025, energy 21%, consumer staples 19%, healthcare 16%, industrials 13%, financials 8%. SCHD is now heavier in energy and consumer staples, two sectors I believe will shine over the next 12 months. Especially if oil stays high and the economy remains uncertain. New top 10 holdings: ConocoPhillips 4.6%, Chevron 4.4%, Verizon 4.1%, Merck 4.1%, Bristol-Myers 4.0%, Avery Dennison 4.0%, Amgen 4.0%, Coca-Cola 4.0%, Altria 3.9%, Lockheed Martin 3.9%. That's a healthy mix of defensive names, strong cash flow companies, and dividend growers. So what does all this mean for the dividend? Yield should hold around 3.8%, and I expect dividend growth to improve, especially with energy stocks climbing in the ranks. ConocoPhillips, for example, had a huge dividend hike in 2022, and that skews its 5-year growth rate upward. But the cash flow is real. Bottom line: don't expect a massive change in yield, But the foundation for long-term dividend growth looks even stronger now. Let's zoom out. Over the last 10 years, SCHD returned nearly 200% total, and from 2013 to 2022, it outperformed the S&P 500 to 262% versus 223%. Yes, it's lagged recently because of the tech boom, but SCHD was never meant to compete with AI moonshots. It's a steady, tax-efficient, dividend-paying compounder. And as a core piece of a portfolio, especially if you're heavy in growth or tech, SCHD is the perfect counterbalance. So is SCHD still a buy in 2025? Checkmark yes. If you want dividend income, checkmark yes. If you want long-term growth, checkmark yes. If you value a rules-based, no BS approach to investing, there's no emotion in its process. No guessing games. Just math, yield, and performance. Let me know in the comments. What do you think of the new SCHD? Which stocks were you sad to see go? Which additions are you excited about? If you got value from this breakdown, smash that like button. It really helps, and if you're new here, hit subscribe. Thanks for watching, and I'll see you in the next video.